So as Chris have introduced, my name is 𝐓𝐿 𝐎𝐿. I'm an senior investment strategist from BlackRock. Sound like a very bombastic term. But what I do is quite simple. Essentially, I generate investment insights that are actionable to help our end clients, people like you and me, to navigate the different market environment. And that includes the current market environment with US policy shift, raising uncertainty. And as a result, more and more investors are at a loss of what to do. In fact, some are somewhat paralyzed by the evolving news flows that's coming in every single day. To make matters worse, US exceptionalism, which has worked well for the past 2 years, is confronted with many headwinds, right? I think we heard a lot about it in today's session. But that being said, amidst all this uncertainty, we still see many opportunities. And some of these opportunities lies in the global markets. In the next 25 minutes or so, I will be, one, dissecting the recent market move, and two, sharing our thoughts on what we think the market outlook is going to be in the second half of this year, and three, proposing 2 opportunities that we think will be optimal to navigate this uncertain market environment in the second half of this year. So as I mentioned earlier on, this year is marked by uncertainty. And we think this uncertainty is likely to prevail in the second half of the year. In this slide, there is a timeline of the different tariff actions that Trump has taken since his inauguration in January. Of course, the markets have been moving to the tunes of Trump tariff. Looking ahead, and I think that's what's more important, there are 2 dates that we need to keep an eye on. The first one being on the 9th of July, we have the end of country-specific tariff. And already we are getting some news overnight on this. So that's the first thing to watch out for. The second date to take note is the end of US-China temporary trade deal. Another key deadline to look for. And of course, uncertainty is not all bad, right? Like I shared earlier on, there are opportunities amidst this uncertainty. So, in this slide, you can see that the effective tariff rate of goods going to US for the past century. Right now, if you take into account all the tariff that Trump has imposed, we're somewhere at the 25% level. So it's a very, very high tariff rate on goods going to US, right? However, Trump have actually dialed back quite a bit of this tariff in the past couple of months. So if you take that into account, right now we're around 12 to 13% effective tariff rate. And at BlackRock, we think the final tariff rate is going to be somewhere around this level. And what this means is, things aren't that dire, but at the same time, they are not all rosy either. So since the imposition of tariff by Trump, economists has actually been downgrading the growth expectations in US. So in the chart on the left, you can see that the odds of recession has risen this year from around 20% since coming to this year to right now slightly above 40%. On top of that, the economists are expecting a resurgence of inflation in the US. So you can see that on the chart on the right. Inflation expectations, different metrics, be it which matrix you choose, you look at, inflation expectations, they are rising. So a combination of slowing growth and rising inflation is what we call stagflation. And of course, this is the picture of the economy, right? This is the current state of the economy. What does it mean for financial markets, you might ask? So on this slide, we have a list of positive and negative catalysts that we see for financial markets in the second half of this year. As you can tell, it's pretty balanced on both sides, right? On one hand, the positive side, potentially we could get some positive trade deals coming through. Of course, earnings has been quite resilient thus far, right? And markets continues to expect earnings to be strong this year as well. Of course, on the flip side, on the negative side, potentially we do get some impact from the higher tariff feeding into growth, into inflation. We do get some negative trade deals headlines that's going to weigh on the markets. Now, you might be wondering, why is there policy on both sides, right? Policy is on the positive side, policy is also on the negative side. And that's because we think that's key. How policies play out in US is going to be key for the market outlook in the second half of this year. Thus far this year, in the first half of this year, we'll be getting the so-called bad policy. And these are policies that are bad for growth, negative for growth, at the same time also negative for inflation. However, we think in the second half of this year, we are going to get more of the so-called good policies. Policies that are positive for growth, somewhat neutral for inflation. But most importantly, if you aggregate all of this up, the net impact of this policy is going to be negative for growth. Growth is going to go lower, but negative for inflation as well. Inflation is going to go higher. Sounds familiar, huh? Because this is a stagflation that I was talking about 2 slides ago. Now you might be wondering, okay, so if stagflation, then how? How do I deal with stagflation? Okay, don't worry. I'm going to be telling you the answer right now. There are 3 key messages you need to remember to navigate an uncertain stagflationary environment. First message, concentration was rewarded in recent years. If you recall, tech, communication services stocks, they have rallied like crazy in the past 2 years. They've done pretty well, very well. But we think in this stagflationary environment, diversification is the way to go. As a result of the strong performance that we've seen from tech and communication services stock in the last 2 years, there is a huge concentration risk in US equity markets now. Almost roughly 50% of the stocks in S&P 500, they are tech and communication services stocks. And on top of that, we think that earnings are going to broaden beyond just your tech companies. You can see on the chart to the right, healthcare and industrials, they are expected to generate a decent amount of earnings this year at 14.3% and 13.9% respectively. So what that means is you need to diversify beyond the tech names. First message. Second message is to look for stocks that have a lower volatility characteristics. Why so, you might ask? Because if we look back to stagflationary period back in the 70s and 80s, when we analyze across the different factors, during that time, we noticed that the low vol factors generated the highest return. And this means if we do go into a stagflation environment in the second half, we need to look for stocks that have a low volatility characteristics. That's the second message. Third message, you need to take advantage of the higher dispersion that is driven by the uncertainty that we are seeing. And what that means is you need to look at active bottom-up strategy to take advantage of this. In this chart on the slide, you can see that the correlation between single stocks, they have been falling this year. Put it simply, stocks are moving in different directions. And to put it even more simply, you can take advantage of these several opportunities that arises from higher dispersion by using an active bottom-up strategy. So, if you put all three key messages together, right? 1, diversify beyond tech. 2, look for stocks that has low volatility. 3, looking for active bottom-up strategy. That gives you our systematic global equity high income fund. These funds provide alpha generation at a much lower beta to the broad market. So you can see from the table at the top of the slide, the fund has a lower sensitivity to broader markets relative to an all-country world index. And that's basically your global equity index, global equity benchmark. And it's also reflected in the chart on the bottom. You can see that the fund itself perpetually has a lower risk level relative to the broad equity benchmark. And the point here that I'm driving is that the fund provides you with lower beta to the markets relative to the broad equity benchmark. And of course, this fund is not just a regular bottom-up equity strategy fund. It employs a systematic approach. Again, it sounds like a very big word, a very bombastic term. In fact, it's quite simple. It's actually a proprietary process that we use to kind of forecast, when is the next dividend date across different countries' equities, right? And using this forecasted dividend date, the investment team that's managing this fund would shift the money accordingly with the objective to try to extract the highest income from the equities. So this fund targets to give 7% of dividend every single year. Okay, so that's one opportunity. What's the second opportunity? The second opportunity lies closer to home in China. So in the past 2 years, I mentioned US have been performing very well. And as a result, there's a record amount of foreign inflows going into US equity. So if you look at the chart on the left, 18% of the US equity holdings, they are being held by foreign investors. And the table on the right shows that the foreign holdings of Asia equities, Asia assets, they are small relative to the foreign holdings in US assets. And what that means is if some of these flows, foreign flows, do come back into Asia, Asia assets are actually well positioned to benefit. And indeed, we're seeing some signs of it. On the chart on the left, you can see that Asian investors have been selling US equities. So where are this money going? They're actually going into Asia equities. So if you look at the red line on the right, Asia equities since March has been actually gradually rising. Of course, you might ask, so why are these investors coming back to Asia? Well, because firstly, Asia equities offers a much modest valuation relative to US. In simpler terms, it's much cheaper than US. So in this chart, you can see that, so this chart is actually a chart that shows the premium of US equity over some of the Asia country equities. A number above 1 means that US is more expensive. And clearly, you can see that most of the Asia country equities is above 1, except for India, maybe slightly at 1, right? But what's more notable is among all these Asia country equities, China is a standout. At the top, it's the pink line over there, right? With a ratio of 2, which means US is 2 times more expensive than China. Of course, cheap alone is not the reason. There must be value, right? Right? Cheap is not the reason. So what is the value in China equities? So going to this year, economic activities have been slowing, financial conditions have been tightening, and this actually led to some economists, investors thinking, could the Chinese government do a little bit more to kind of boost the economy? And if you look at the timeline at the bottom, July, the end of July, there's a Politburo meeting, and markets are expecting a stimulus package to come out from it. So that could potentially be a catalyst for China equities. And of course, we have been hearing that tariff is going to affect China companies. We acknowledge that. But at the same time, we want to point out that the onshore companies, the onshore Chinese companies, they're a lot more insulated. If you look at the chart on the left, the Chinese onshore companies generated 82% of their revenue domestically. Only 18% are generated outside of the borders. So they are relatively insulated. They are relying on their local economies. And that explains why the earnings expectations for for China equities, they have been rising. So if you look at the purple line in the right chart, it's at 17.9% earnings growth expectation this year. So it's rising. And interestingly, all the other countries' equities, regional equities, they are falling. So China is obviously, onshore China equities are obviously being regarded as sort of a good shelter and safe haven from tariff. And we also make the point that China is a lot more better prepared this time around. And this is evident in the positive flows going into China in this Trump term relative to last term. And also the DeepSeek movement has helped to drive additional flows into China in the second quarter of this year as well. And if it's still not obvious enough, the second opportunity is onshore Chinese companies. And you can look to FTSE China A50 to gain access to the onshore China equities. And for those that are still not convinced, maybe one last reason to convince you and bring home this message is that the onshore companies, they are trading at a much cheaper valuations than the offshore companies right now. And this is relative to history, right? On this chart, anything below that line that you see effectively means China onshore is trading cheaper. And right now, you can clearly see that we are below that line. Of course, if you forget everything that I've shared in the last 25, 30 minutes, fret not. You just need to remember these 3 key takeaways. Number 1, uncertainty is not all bad. It does present attractive opportunity. And the first opportunity being dividend equities. Of course, the fund is systematic global equity, high income. They're of higher quality, lower volatility, at the same time offering you the downside protection and also the income that some investors are after. The second opportunity lies in the China onshore companies where there's lower US exposure, there is also national team buying that's helped to backstop the stock markets. And lastly, it's a huge beneficiary of domestic policies. And potentially, if we do get stimulus in July, that's going to be a very strong tailwind. So with that, I thank you all for your kind attention. You've been a great audience, and see you around.